Hi, welcome back to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Tren Griffin. Tren works at Microsoft and was previously a partner at Eagle River, a private equity firm with investments in the telecommunications and software industries. His early career included 5 years working and living as a business consultant in Korea and Australia. Tren blogs about investing and other topics and is the author of the new book, Charlie Munger, The Complete Investor. Tren spent years studying Charlie in preparation for writing this book. Let's ask him 5 good questions. Welcome back to the show, everybody. My guest today is Tren Griffin, author of Charlie Munger, The Complete Investor. Hey, Tren, thanks for taking the time to chat with us today.
Great to be here.
Let's get started. All right, question number 1. In your book, you have this concept of margin of safety as explained by using a safe high freeway driving speed. I thought it was a really clever way of conveying it. I'd never heard that way before. Could you explain it to us again, and so that we can understand it better?
Well, the fundamental point that's being conveyed, and it's not my original idea, I forget exactly whose idea it was, but the fundamental point that's being conveyed is Graham's point about margin of safety. And he made this point that many people have a huge problem understanding, which is the purpose of a margin of safety, Graham said, was to avoid the necessity of forecasting. And when you buy at a margin of safety, say 70 cents on the dollar or 60 cents on the dollar, you can have a number of future outcomes and still have a good result. So as Munger would say, you can make mistakes and still come out okay. And so a safe driving distance doesn't require you to forecast the behavior of the driver ahead of you. Now, if you're buying a dollar for a dollar, it's the equivalent of tailgating. You have to be right about the person ahead of you. And if it moves quickly, you can't really adjust. And so it really has to do with what Seth Klarman calls risk avoidance, which is you have to buy at a margin of safety, which gives you this protective barrier against making mistakes. As Munger would say, the best way to be smart is not to be dumb. And one way to not to be dumb is to have this margin of safety, because you can make significant mistakes and still be okay. And then if you're right, you clean up. And so that's the purpose of a margin of safety. The hard part about that is you're not going to get to buy a dollar for 70 cents very often. So most of the time you do nothing. You wait and you read and you read and you wait and you watch and you watch. And then all of a sudden there are these opportunities. And at that point, you need to jump in. And that's this weird combination Munger talks about. You need to be patient and aggressive at the same time. Seems like a paradox, but it's not.
Yeah. I think he's called it like pounce vigorously when the chance arrives.
Yeah, that's exactly the phrase he uses.
So question number 2, I've always found it interesting, and I think this comes basically from Warren Buffett's pretty clearly expressed view that value investors tend to avoid anything macro related. They just have this aversion to it. And I've always kind of wondered if they weren't throwing out the baby with the bathwater a little bit when it comes to macro valuations. In my mind, something like market cap to GDP or Tobin's Q or Shiller PE, I almost see those as a Mr. Market analogy writ large. Are the typical value investors missing maybe something important there, or is this stuff just a distraction from individual company research?
So the way I look at it, and actually I should talk mostly about Munger because that's what the book's about, is Munger is a student of complex adaptive systems. And he believes the economy, he believes companies are all complex adaptive systems. And trying to make forecasts about complex adaptive systems is basically impossible. Even after the fact, you can't determine causation. So basically what they've done with the margin of safety concept is said, look, if you have this buy a dollar on 70 cents mentality, you don't have to make forecasts. And so what you should do, Klarman would say, is always in that case, rather than making forecasts, build bottom-up models of individual companies. And what happens in that case is having enough cash at a bottom, near a bottom, ends up being a residual of a disciplined bottoms-up process. So Charlie Munger nearly bottom-ticked 2009 when he bought the Wells stock out of the Daily Journal stock.
Yeah.
And he didn't do that by predicting the economy. It's just Wells got to a point where he said, all in, this is the time. But it wasn't. Two things happened. you had enough cash at the right time. That's a residual of being disciplined about buying stocks bottom up. And then the other thing, he was willing to sort of jump in, and he analogizes it to poker, which is really good poker players don't play many hands, and so you just wait and wait and wait, and you see the hand, but you don't. He didn't make that call in 2009 based on any Tobin's Q or anything like that. He made it based upon the fact that Wells was trading at a great price, 70 cents on the dollar. Let's jump in. You got to be brave at the right points, and the rest of the time, as he says, you sit on your ass.
Yeah. So what would you say then about the fact that he was 100% Treasuries in Daily Journal going up into basically like 2008?
So the way they look at it is really their hurdle rate is their next best opportunity, and your opportunity is always to buy the safest asset that there is, and so as a default, both of them will move into Treasuries. They happen to be in Treasuries because they couldn't find anything to buy, and so it wasn't sort of okay, well, the rates are going up, or Yellen might do this, or the committee might do that. It's just the Treasuries happen to be their next best alternative. And so the stuff tends to pile up when they can't find stuff to buy. And so the message there that I see is that if you take care of the micro, the macro takes care of itself. Because if you're only buying stocks in a disciplined way, you'll tend to have cash at the right times. Now, this requires some special characteristics, because you're necessarily not going to be participating fully during a bull market, because you can't have cash at a time like 2009, to give Goldman 10 billion if you're just piling on and being momentum investors. So it is a conscious choice. It is their particular skill set. It suits their personality. Now, if you listen to Marx, he basically says the same thing about forecasting and all that, but he also says he's not oblivious, to some of these other macro metrics. He's paying attention.
Yeah.
But his fundamental decision making, from everything I've heard, everything I've read, it's a residual of a bottoms up process. And they're of course buying in the private markets, and they see stuff that we don't all see. So they have a lot of micro data that we don't have.
Question number 3. How do you know if you're smart enough to be a Charlie Munger style investor with, let's say, high concentration, the ability to spot a sustainable moat without falling prey to the idea of overconfidence bias? To me, that seems like an incredibly fine line to walk.
Well, the key point there is that IQ can be negatively correlated with result. Buffett says you need an IQ of about 125, so you need to be above average. But then the key point after that is your IQ should be greater than what you think it is. As Munger says, it's the people who have a 140 IQ who think it's 180. They get you into the biggest trouble. He loves the chapter in Gladwell's book where he talks about these people who have off the charts IQ and are absolute basket cases. Right, and the important thing there is it is temperament. It is emotional and psychological stability, which determines your success as an investor once you reach 125. And I think 125 is arbitrary. I don't think it's a special number. What he's saying is you need to be smarter than average, but that's not enough. You need to work harder and enjoy working on this particular stuff, and you need to be able to keep control of your emotions. So you're not basically in a situation where you're selling low and buying high, and so it takes a certain emotional maturity. Some people have called it emotional intelligence, but the key thing is IQ. At some point, Buffett has said that you could give 30 points away after it's 125. In other words, if you think you're too smart, that's a problem. You want somebody who's humble. I mean, Munger has this strange. Again, it's a paradox, but he's a guy who talks about his mistakes. He's a guy who talks about humility, but he's also got a ton of chutzpah, obviously. Mm-hmm. So it's this combination of being aggressive, being confident, but only confident in situations where the odds are really great. Like make bets when the odds are really in your favor is like a Munger mantra.
Yeah, I've heard it said before that you have to be a real genius to lose billions of dollars, and that's I think the danger that can happen.
Well, the the amazing story that sort of I've read recently was the Soros situation where someone came to him and said, Druckenmiller came to him and said, "Hey, I get this great play on the British pound," and Soros looked at him and said, "What are you talking about here? What are you talking?" He goes, "You should double down on this. You should lever up. This is such a great opportunity. These things don't come along very often." And having the temperament, the ability to say this is such a great bet. And the analogy Munger uses is occasionally when you're at a horse track, there'll be some horse that just has really great odds. It's not the most famous or the best horse. It's just the odds are just insanely good. So anyway, that Soros bet was an amazing case of somebody realizing, very few times in life. Buffett and Munger have both said it's about 20 decisions in their whole life that has made the decision that has made the progression of their wealth be what it is. And so, doing the right thing in a small number of times it is a key part of their process.
Yeah, that's true. I mean, there's a lot of very pedestrian investments that they've made, but then some that have been just so outlandishly successful that that's what's made the big difference.
And those things don't come along very often. And when they do, you sort of have to pile in. But it takes a supreme level of confidence, but also to act quickly. You don't say, "Oh, that might be an opportunity. Let me start researching." All those books behind you. They're reading books. 5 newspapers a day. They're already ready. But here's a guy who's doing all this stuff and making relatively few decisions. Staying up on everything, because when it happens, it's going to happen only for a short window of time, and if you don't jump in, then you're going to miss it.
Yeah. So question number 4, and it kind of relates to question number 3, but Daniel Kahneman, the father of prospect theory, has doubts about his own ability to overcome his own heuristical biases, his own cognitive biases. What can we do to potentially safeguard ourselves?
So I think the key thing there is the Munger 2-track process. And the Munger 2-track process is basically, in the first track, you make as rational a decision as you possibly can. Use a disciplined process. You go through this rational process. And this applies to any decision, by the way. And then once you finish the decision, you go back and you apply the ideas in his Psychology of Human Misjudgment speech, which is you go cross-check it for all the heuristics that can produce a dysfunctional decision. So you look for availability bias, anchoring, loss aversion, self-interest bias. And so it's similar to his worldly wisdom idea, which is he's sort of applying a last work here where he's looking at a lot of different psychological heuristics, say 100, and trying to basically see whether he's made a mistake. Now, the other thing what he said is you don't have to be right in every case. You just have to be ahead of the pack, and you're going to make mistakes. I'm running a blog piece this next weekend about his mistakes, and he loves to say that I rub my nose in my own mistakes. I keep making mistakes. I will continue to make mistakes. But the important thing is well, there are 2 points. Michael Mauboussin has this point where, first of all, it's magnitude of success that matters. Mm-hmm. And then the other point that Mauboussin makes is that it's process that matters. Even if you're in Vegas and the dealer, flips some lucky card and you happen to lose, as long as your process is different and you're counting the cards correctly, you can be okay.
Yeah.
And so sound process is key for Munger, and checking for those biases is the key second step.
That's good. So question number 5, and you make an interesting observation and a distinction between a Grahamian value investor and a factor investing with a value tilt. So the first part of the question is, where do you think that Joel Greenblatt, specifically his magic formula, fits into that kind of in between those distinctions?
Well, he's an interesting guy, and one of the things that I talk about in my book, my Charlie Munger book, is that value investors, some of them are really focused investors, and they have a very small number of stocks. That Ackman doesn't have a lot of. You lose 13F. There's not a lot of stocks there. And then you take a look at Greenblatt, and he's got large numbers of stocks.
Yeah.
But what he explains in his book, and this is really interesting, which is if he was investing his own money, he'd have a lot fewer names. But because he's actually raised a fund and he has outside investors, he knows that outside investors tend to run during a panic. And so he has chosen, and he says this, all right, I've chosen to own more stocks than the ordinary investor would, because I know that my investors may not be able to control themselves during a drawdown. And so he's on the high side of how many stocks he owns. The problem is the more stocks you own, the more correlation you have to the index. So it's hard. I don't know exactly where it falls out. In my own portfolio, I'm much more like Munger, just because I don't want to fall on the side of closet indexing. So anyway, he is doing things that he has to do because to protect his investors. The amazing thing is Buffett, who was so smart. He basically said, look, he had the same problem. And what he basically said was, well, but once I move to a corporate structure like Berkshire, basically he has permanent capital, which Berkowitz says is one of Buffett's major secret sauces, which is when there's a drawdown, you can't file a redemption request, right? Yeah. With Berkshire, you can sell your stock.
Berkowitz definitely knows all about the redemption requests. Yeah,
it's hard because you have drawdowns in two situations. You have drawdowns on the way up when the investors say, "But you're not doing as well as these momentum guys," and that's a necessary price of being a value investor, right? So you have that problem. And then on the downstroke, people say, "Oh my goodness, I'm going to lose my money. I'm going to jump up now," which tends to be the worst possible time. So you've got you've got this drawdown problem, and people sometimes say, "Well, Buffett spends all this time at meetings and writing letters, and all these things, educating people." And you can say it's great education, and it is, but it also has sort of a golden benefit in that he's got the shareholders that he wants. In other words, when you go to Omaha and you see the people there, these people have been conditioned. Like, you're going to underperform a little bit on the way up. And when it goes down, hang tight. Don't bail into cash. And that's work. And I think other investors have picked that up. So you get more and more of these people writing Buffett-style letters, trying to get their shareholders. Because, if you're a fund, having great shareholders or LPs is a competitive advantage because they'll hang in. They understand the process. They understand how you make money in a value investing situation. But the key thing is if you're just buying an index and you have a value factor, it's Fama, other people have shown there's a little bit of juice there because there is a factor. But that's not like picking stocks, being an active focus investor, or like Marx and Klarman, also in Buffett, being in the private markets. Buying assets in the private markets is something that you're not going to get in an index fund. It's just a different game. And Marx is in distressed. These guys are playing a completely different game than some big fund. Name the big fund name value fund. It's just an index fund with a value factor. It can be a decent bet if you want to bet that, but it's not Berkshire. It's not a Howard Marks fund.
Right. So our bonus question that we always ask, we need a book recommendation, and we're looking for something that you feel is maybe underrated or just hasn't gotten the kudos that it deserves. What do you have for us today?
So I really am a big fan of Robert Hagstrom, and he wrote some great books. I wish he'd write another one, but the one book that I think people should read of his originally was titled Investing the Last Liberal Art, and it has a new title. I'm exactly forgetting what it is. But if you go into a search engine, you'll find it. But basically, I love the title, even though they abandoned it. And the point he makes is to be a great investor, you really have to be widely read. And he was one of the first people who really tried to publicize this idea of a lattice of mental models, which is, unless you are reading in many different disciplines, science, mathematics, philosophy, biology, you sort of start going down the list, you really are not going to be a good investor, because you won't be able to basically apply these other models to the opportunity in question. And if you just know math, or just know economics, or if you just know business, that isn't enough. You need to read. You need to talk to people. You need to understand science. You need to have some ideas about philosophy. And these fundamental models like return to the mean, and you start going the loss aversion, you go down the list. Unless you know these models, you're going to be in trouble. And he said there are approximately about 100 models. And in a blog post a couple of weeks ago on Worldly Wisdom and Mental Models, I listed them. Originally, it was in the book, but the publisher thought it was not
too much.
It's too much. I mean, the difficult thing about writing a book is you only get so many words. You get a budget, and then the other thing is you have to make it so it's readable by enough people that it's not a specialist book,
mm-hmm.
but it has to be true to form. And so you have this tricky thing about what you put where. And so, as an example, in my book, I put the chapter on moats in the back. And the reason was it was in the middle, and I just felt like a lot of people were going to say, wow, this is too deep, this is too heavy.
Because what I
want people to do is to say, this is just a great way to make decisions about my kids, about my life, about everything, or just choosing your funds, right? It's a great way to make decisions. If you're actually going to be a focused investor, do what Munger does, you're going to have to understand that appendix. But at first, I got to get you through the book.
Yeah.
And, again, if you pay $17 and buy the hardback, or $13 and buy the ebook or whatever, it's a great value, because if you can't read it, it's telling you something. It's telling you that you shouldn't be yourself an active investor. And I guess sort of the last piece that Hagstrom sort of conveys well, which is this stuff is work, and unless you really love it, it's probably not for you. You should.
It's not for dabbling.
But it's like a lot of people are going to be a lot happier playing golf or scuba diving or whatever their thing is than on reading an annual report on a Saturday, right? And some people are just going to, just tiptoe into their office thinking, oh boy, I got some time to read some annual reports this weekend. So it's sort of like what suits your nature.
Mm-hmm.
And the phrase Buffett uses is once dumb money acknowledges that it's dumb, it becomes smart. So that's the paradox. But it's also once you realize your own emotional limitations, you become more mature. Because maturity, you must be mature to make these correct decisions. And the key decisions are basically not to buy high and not to sell low. And that requires that you be a contrarian. And being a contrarian requires some backbone and some thoughtfulness and some, basically ability not to separate yourself. And so the message, going back to your previous question, what Kahneman delivered was, look, I've been studying this stuff for decades, and I still fall for it. The example he gave was, when I set out to write my book, I was way overconfident about how long it was going to take me to write it.
Mm-hmm.
And that's an example of the overconfidence still conquering a guy who's been basically studying it for decades. So we're all going to make mistakes. We all should be humble. If we work hard, we'll do better. But then, like I said, the last point is, none of us are going to be Charlie Munger. There's never going to be another Warren Buffett. But you can get better. You can learn incrementally. And that's the important thing, because those guys are unique. You're unique. I'm unique. We all have our foibles and mistakes and faults, and we all have our strengths. And so we're all unique. So you're not going to be Charlie, but you can learn from Charlie, I guess, is the final point from the book.
It's perfect. Hey, Tren, thanks for taking the time to chat with us today.
Great.
All right, take care.
Take care.